Clueless say it again. I've absolutely no idea when that 15-minute recording on the first segment ended. But just to go on this is a weekly chart of the market. Nothing here shows me that we are going to about to crash and burn. Looking at the internals here, which is the simplest way of looking at it. You don't need to be a rocket scientist to figure it out. Somebody on StockTwits once wrote, if you can join points A, B, C, D, why the heck do you need those PhDs at Goldman Sachs to figure out what's going on? Well, I don't want to make that simple, but at the same time, let's take a look at this. These internals are saying that if this market, if these lines still stay above and either they go like this, then this market is going to hit 2127 on the E-minis. That's about 2134 on the S&P 500. Nobody wants to believe it. The best part about the market is that everybody's playing defense. Nobody's playing offense. I am not playing offense. I'm trading, but I'm not trading as aggressive as I should. Does that make me happy? Absolutely not. Because 90% of my charts and my predictions are coming correct on the upside and the downside, mostly on the upside. Am I taking full advantage of it? Absolutely not. So what are the rest of you guys doing? Guys and girls, you're way behind. So think about it for a minute here. If everybody's so as scared, shit scared, okay, excuse my French again, then why is the market continuing to go higher? Because the market climbs a wall of worry. Now, if these lines turn like this, and you can see these all in your own screen. I don't need to, I'm just showing you how to self-teach yourself because nobody taught me. I sat with some of the best minds in technical analysis business on their side. I saw what traditional technical analysis was all about. I saw how wrong they were. And in this day and age of algorithmic high frequency trading, they are dead wrong. And that's the reason why everything that you hear from the media, everything that you see from the hedge funds are nothing. Anyway, if these lines turn, all bets are off. If we close below 2000, we're going to come down and test these lows. We don't hold these lows. Well, that's a different day story. We'll see where we go. So it's right there for you to see. But for you to work on, just can't rely on me because I am no genius. I'm just somebody who's a fast learner and somebody who's a quick thinker. Now, let's take a look at bear with me. Then I'm going to pull this up right there. Another set of charts of TradingView. Very easy to see. Anyone can use it. In my group coaching sessions, I've taught people how to use this. And the ones who have, they've benefited tremendously. There are people in the group who are making $20,000, $30,000 off a trade. Are you even close? They're not even playing with that big money, but they're making it because they are acting on things. Because they not believe. I don't like the word believe because nobody is a guru. I'm certainly not. Um, the point is that you have to learn how to read these things. So look at this chart here. You got a 34-day moving average. You got a 50-day moving average. Still crossed over. Still moving up. Remember, the worst thing you can do to yourself is ignorance and your stubbornness and denial to realize how stupid you are. Because that's what I tell myself all day long. How stupid I am not to make $100,000 of each trade. So if I question myself, shouldn't you? So saying all that, let's take a look at this. You got a 34-day moving average. You got a 50-day moving average. 50-day moving average is at 204.63 on the SPYs. A lot of you are SPY traders. A lot of you trade indices. So right there. Then you got 34 here. So if we lose this, we're going to come down here. As long as these lines don't curl down, change color. What do you change color? Right up there, right? As long as these lines don't move down, you are A-okay. You have to read all the nuances in the market. Look at the stochastic. This is a 1-hour chart, the trader's roadmap. Every time you get oversold, like we did today, this takes time. It took the whole day to get oversold. It's not fully oversold yet, but almost there. You get a bounce. You get a bounce. You get a bounce. Obviously, of these lows, you get a serious bounce. Were you there? I was suggesting things to buy. So at this point, is it possible that we get a bounce here and another mini dragon bullish formation is formed, which brings us either up to the highs of 208 from yesterday? Let me get these lines out. Hold on. Okay, wait, just have patience. So is it possible that we have this type of thing? Absolutely. So just because we collapse a little bit more, does it mean much? Not to me. But at the same time, given where we are right now, I believe that we should hold the 34-day moving average and move from here, given the seasonality of what's going on. And then we move up towards this range. Once you get up here, there's a big fat red arrow. I can't make it any easier. This is kindergarten stuff. You gotta sell. You have to sell. Now, if this happens and we get down to 204, don't panic. We'll short from this point on, because if we lose the 34-day moving average right here, then there is no reason to have a tactical short all the way down to the 50-day moving average right there on on the hourly chart. So it'll be like this. And of course, the gap fill was already done. We filled the gap. This was the gap. We already filled that gap and we bounced exactly off that. Is it possible to come back and retest that gap again and move from here? Absolutely. Once we lose this, that's when you start to get bearish. Once you lose the 204 level on the SPYs, you will retest the downtrend channel at 202. It's a pretty good sum of money down here. However, if we bounce from here, given the seasonality, given the fact that the majority are still bearish, it's a fact. It's shown up in the numbers. Look at the strike price on the S&P options. Then we should expect a fat bounce here. Okay, that's it. Now, this has to be taken into account. Deep oversold. However, when you look at the vortex indicator, you're starting to see almost a crossover of the green line below the red. If that happens and the green line crosses down, you know what that means? That means we're going to go down towards this level. So you have to be tactical and you have to think smart. You don't need to put out large positions out there. You have to put out positions that you can maneuver. Right? Now, let's take a look at this. I shall put it like this. And I will close this. And take a look at this. So here we are with another version of charts that I look at, because I am, after all, a quant chartist. I'm a visual chartist. I'm not here to make you happy by giving you commentaries on great old stuff, right? So this chart is very clear. You got the buy points and the sell points. So at this point, we have a buy point here at the 50, same thing that I showed you, which is around 2050. We have a gap fill here, which the market, if it holds here. And I will get that line. Okay, so best case scenario, we come down to 2040 and then we bounce hard. Otherwise, we bounce here, get up to the downtrend line, up to that arrow around 2080, 2086, and believe me, it can happen by tomorrow. Because right now, the fund managers are desperate for performance. Underperformance anxiety out in the boardroom, in the bedroom. All jokes aside, trust me when I tell you, 90%, 80% of hedge funds and 80% of mutual funds are underperforming the basic indices. They're trying to catch up with the Apples, the Googles, the Teslas, you name it. That's why you see the run up. There's no reason for the stocks to run up like this at this point, given the fact we don't even know what their earnings are going to be in January, right? So, saying all that, if we get up here, sell. If we get down here, buy. And I believe this run up will continue for a few more days. And we could possibly run up towards the first week in January. Why? Because that's when, and you've heard people who have followed me for a while, and you know I've been correct 100% of the time, where the large money, the pension fund money, and the institutional fund money gets into the market in the first 5 business days of the month. So figure out what the first 5 business days, not calendar days, of January are, and then you know what it is. In the meantime, selective issues that we're talking about are going to do extremely well. Look what we did with FXCM, 30% almost in 2 days. Look what's going on with Chimerix. Selective issues that have nothing to do correlated with the market. That's what it's all about. In the meantime, sleep well, kiss your kids, say hello to your wives and husbands, and stay strong. Because, like I say, the lion does not listen to the advice of the sheep. So who's the sheep? The sheep is not you. The sheep is the little demons in your head who tell you not to do things. So get out of that little trap. I've been there. It doesn't feel good. You don't need to listen to Oprah and and Dr. Phil to realize what your potential is. Your potential is far bigger than what you're doing right now, because that's what I keep on telling myself. Okay? So what I do is provide some very tactical tools to make you realize that you're much bigger than what you think you are. So stop being scared all the time. Right? Almost oversold. Let's see what happens. Thank you for listening. Good night, because I got to go to sleep.